Hello again, and in this short lesson for beginners, we are going to cover the basics of chart patterns. What are chart patterns? We are going to cover that very question, as well as what are continuation patterns and reversal patterns, and we're going to look at some example images of each. Now, there are several patterns that are formed on price charts that lead to predictable moves in the market. When you see these patterns develop, which a trader will, having a little bit of experience, eventually get to see, you will have a better idea which way the market will break out and can then take advantage of that. Now, we can look at chart patterns as continuation patterns or trend following patterns. These would involve symmetrical triangles or pennants, ascending or descending triangles, flags, and rectangles. And we'll also take a look at what's known as reversal patterns or counter trend patterns. These would include, for example, wedges and head and shoulders patterns. Let's start then with symmetrical triangles and pennants, which are part of the continuation patterns. The price action retracts into a narrower and narrower configuration. It squeezes itself from both the top and the bottom. The symmetrical triangle and the pennant show up just before the market takes off in its original direction. Now, let's have a look at some images here. With the symmetrical triangle on the left, the market generally eases into the formation, while with the pennant comes after a very sharp and quick move by the market. The long, sharp, steep market move in front of the pennant is called the pole. For ascending or descending triangles, these are similar to symmetrical triangles, but in this case, the leading edge of the triangle is a flat line, a horizontal line of support or resistance. You'll notice that on the bottom left in the descending triangle image, there's clearly a horizontal line of support. While in the right image on the ascending triangle, there's clearly at the top a horizontal line of resistance. And you'll see in each, price moves between the two lines until eventually it breaks through. Now with a flag, it starts off generally with a large quick move forming a fairly steep pole. Next comes the flag formation, and it gently moves up and down, slightly against the initial move. To be a true flag, the formation takes place between two equally separated lines, a small support and resistance channel. Let's have a look at the image. Here we have an example of a bearish and bullish flag. The bear flag on the left is formed as a slightly rising formation, while a bull flag is a slightly falling formation. Now, with bearish and bullish rectangles, similar to the flags, the market is considered to be in a range. As price slows down after a bigger move, it will want to drift sideways for a bit. The price floating up and down as regular business in the world influences price, but it's pretty stable. So we can see on the left there, we have the bear rectangle and the bull rectangle on the right. And as price moves into the rectangular formation, it hits support, hits resistance, hits support, hits resistance, and then while moving sideways, eventually breaks downwards. While in the right image, it moves upwards, hits resistance, hits support, hits resistance, hits support, and eventually breaks through the resistance level upwards. Now, price action that you can sandwich between two horizontal lines, support and resistance lines, is basically a continuation pattern. You'll find this after a big move, and also after the major market participants go to sleep on a smaller time frame. A pause in the market that has already clearly defined highs and lows forms such a pattern. It can be very narrow, as in a consolidated market, or a little wider when there's an actual price movement outside of it. This is the classic formation for a breakout type of trade. And I'll show you an image shortly. We're going to look at wedges in this example of reversal patterns. This happens almost every time a decent reversal is about to happen. A bullish wedge occurs when price must be trending lower. At the bottom of the trend, the last couple of lows are very shallow, almost a kind of bottoming out. The first low is followed by a slightly lower low. The highs, however, are not as shallow. They keep falling more dramatically than the lows. So here we can see on the left-hand image a bearish wedge, and on the right-hand image a bullish wedge. Topping out of price occurs as price narrows, followed by a reversal. So you'll see the price hits on the left, for example, hits the upper resistance level, down to support, narrows a little bit towards the resistance levels, narrows down to support, and so on. So it's the two channels there are basically narrowing and forming a wedge. And eventually it breaks through to the downside. Similarly, with a bullish wedge, eventually it breaks through to the upper side. Now, another reversal pattern is the head and shoulders pattern. And this is probably, I think, the most popular chart pattern out there. There are traders that look for this formation almost exclusively, and they can do very well trading it. It consists of a high being the left shoulder, followed by a higher high marking the head. Finally, there's another high that is lower than the head, forming the right shoulder. So here we have an example of a head and shoulders pattern on an image. This consists of a high being the left shoulder, followed by a higher high making the head. Finally, there's another high that is lower than the head, forming the right shoulder. And eventually, it breaks through a neckline. You'll see a line can be drawn at the lower lows, or the lower highs in this instance, and eventually breaks through to the downside. The head and shoulders pattern is a bearish pattern, and it starts with a higher high and a higher low. What follows is a lower high. This interrupts the pattern of an uptrend and is the beginning of a downtrend. The head and shoulders pattern assumes that the beginning of a new trend direction will have some follow-through. Now we also have what's known as an inverted head and shoulders. This is the bullish version of the pattern, and you can see the two patterns. One to the left, the standard head and shoulders type pattern that we've covered, and the other is the inverted head and shoulders type pattern, where price hits the line as a resistance level, eventually moves above it. It is exactly the opposite of the main head and shoulders type pattern. I hope you've learned something here today, and I look forward to speaking to you again in the next lesson. Thanks, guys.